Most people believe the money in their account cannot simply be switched off. The balance is visible. The card works. The app opens normally, so the assumption feels obvious. If the money is there, it must be usable. But inside modern financial systems, usability is not guaranteed by the balance. It is controlled by the system that allows the balance to function, and that system has the ability to disable access, not by removing the money, but by interrupting the mechanisms that allow it to move. If that sounds unlikely, consider a simple question. When you make a payment, what actually moves? The answer seems obvious. Your money moves from one account to another. A digital transfer appears to represent value leaving your balance and arriving somewhere else. Yet the process happening beneath that screen is far more complex. And once you see how it works, the idea that access can be disabled becomes less surprising. Because modern money does not exist as something you physically possess. It exists as permission within a network. And permission can be withdrawn. This is not a conspiracy or an emergency scenario. It is a structural feature of how financial systems are designed. Modern banking infrastructure was built to manage risk, enforce rules, and maintain stability across millions of transactions. To do that, the system must retain control. Control over who can access money. Control over when money moves. Control over when it stops. Most of the time, that control remains invisible, but it is always there. To understand why, we need to start with a simple but rarely discussed fact about bank accounts. The money in a bank account is not physically sitting in a vault waiting for you to use it. When you deposit funds into a bank, those funds legally become the property of the bank. In exchange, the bank records a liability, a promise that it will repay you when requested. Your account balance represents that promise. It does not represent stored currency. Banks then use deposited funds as part of their broader financial operations. Loans are issued to borrowers. Securities are purchased. Liquidity is managed across markets and institutions. The system works because depositors generally do not withdraw all their funds at once. This structure is known as fractional reserve banking. It allows the banking system to expand credit and support economic activity. But it also means deposits exist inside a system of obligations rather than isolated storage. That system depends heavily on digital infrastructure. And digital infrastructure is controllable. When you pay for something with a debit card, the transaction travels through several layers of financial networks. The merchant sends a request to their payment processor. The processor communicates with card networks. The issuing bank evaluates the transaction. Multiple systems evaluate the request simultaneously. Does the account exist? Is there sufficient balance? Does the transaction appear legitimate? Does it comply with regulatory rules? If everything aligns, the system returns a simple response. Approved. But the approval is not automatic in principle. It is conditional. The bank must allow it. The payment network must allow it. The compliance systems must allow it. Any one of these layers can stop the transaction. If that happens, the payment fails. The money remains in the account, but the mechanism that allows it to function has been disabled. The ability to disable transactions is not a rare capability. It is built directly into the infrastructure. Banks maintain fraud detection systems that monitor transaction patterns in real time. If a purchase appears suspicious, the system may decline it instantly. Sometimes a text message or app notification asks the account holder to confirm the purchase. Until confirmation is received, the transaction is blocked. From the bank's perspective, this protects customers from fraud. But structurally, it reveals something deeper. The bank has the authority to disable your ability to use the account. This authority expands further through regulatory compliance. Financial institutions operate under strict laws, requiring them to monitor accounts for illegal activity. Anti-money laundering regulations, sanctions enforcement rules, and financial reporting requirements force banks to review transactions continuously. If a transaction triggers certain criteria, the bank must intervene. Accounts can be frozen, transfers can be blocked. Access can be temporarily suspended. Again, the money does not disappear, but the system stops it from moving. The concept may seem extreme, yet most people have experienced small versions of it without thinking much about the implications. A card declines unexpectedly. A bank transfer takes longer than expected. An account requires verification before allowing withdrawals. Each event feels temporary and procedural. But each event reveals the same underlying structure. Your access to money depends on systems you do not control. The deeper we look into the architecture of digital finance, the clearer this becomes. Modern payments rely on centralized networks that coordinate transactions between institutions. Clearinghouses manage settlement between banks. Card networks route payments through international infrastructure. Regulatory systems monitor financial flows across borders. These systems exist to ensure trust. Without them, modern financial markets could not function at scale. But they also concentrate authority. Control over the network means control over the flow of money. This control becomes particularly visible during moments of financial stress. When banking systems face instability, authorities sometimes impose temporary restrictions on withdrawals or transfers to prevent panic. These measures are not designed to confiscate funds. They are intended to slow the movement of money long enough to stabilize the system. However, the practical effect is straightforward. Access becomes restricted. History provides several examples of this dynamic. During financial crises, governments and banks have occasionally limited withdrawals. They imposed capital controls or temporarily closed banking systems to restore order. In these situations, the deposits still exist, but the ability to use them disappears. The key point is that the mechanisms enabling these actions are not created during the crisis. They already exist. The financial system maintains them as contingency tools, even outside crisis conditions. The structure of digital finance allows institutions to exercise control over accounts with remarkable precision. Modern financial monitoring systems analyze enormous volumes of data. Algorithms detect unusual activity patterns and flag accounts for review. Payment processors coordinate with global compliance databases to enforce sanctions and regulatory rules. All of these systems operate automatically. Most of the time, they simply allow transactions to proceed. But when necessary, they can stop them instantly. In effect, the financial system functions like a permission network. Every transaction asks for approval. Every account operates within rules. The rules are defined by institutions responsible for maintaining stability and enforcing regulations. Individuals participate in this network as account holders, but they do not control the infrastructure itself. This asymmetry is subtle because the system usually works without interruption. Balances remain accessible. Transactions proceed smoothly. Confidence remains intact. But the authority behind the system does not disappear simply because it is not visible. It remains embedded in the architecture. Over time, technological advances have strengthened this architecture. Digital banking platforms allow institutions to monitor transactions in real time. Regulatory frameworks require detailed reporting of financial activity. International cooperation between financial authorities expands oversight across borders. The result is a financial system capable of tracking and controlling monetary flows with extraordinary efficiency. This efficiency improves security. It reduces fraud. It helps maintain trust in the banking system. But it also reinforces a quiet reality. Money inside the banking system is not entirely autonomous. It operates within controlled infrastructure. Infrastructure that can intervene. Infrastructure that can pause transactions. Infrastructure that can disable access. The word disable may sound dramatic, but in practice it often appears as something far less noticeable. A payment that fails. A transfer that requires review. A temporary account restriction. Each moment reveals the same principle. The system determines whether the account functions. As financial systems become more digital and interconnected, this principle becomes more important. Cash once provided a parallel form of money that existed outside digital oversight. Physical currency allowed individuals to transact without interacting with centralized financial infrastructure. But the role of cash has steadily declined. Most economic activity now occurs through electronic payments. This shift increases efficiency and convenience. It also increases reliance on financial networks. And reliance on networks increases dependence on the institutions that operate them. Those institutions exist to maintain stability across the entire financial system. They do not exist primarily to maximize individual autonomy. When the two priorities conflict, stability tends to prevail. That priority shapes the design of modern banking. It explains why financial systems maintain the ability to intervene in accounts. It explains why transactions require approval. And it explains why access can be interrupted even when the balance appears unchanged. None of this necessarily signals a failing system. In many ways, these mechanisms are what allow modern finance to operate safely at global scale. But they also reveal something important about the nature of money in the digital age. Money is no longer simply something you hold. It is something the system allows you to use. The balance in your account is real. The claim it represents is real. But the functionality of that claim depends on infrastructure you cannot see and rules you do not control. Those rules were built gradually through decades of regulation, technological development, and financial crisis response. Each layer added new forms of oversight. Each reform strengthened the system's ability to intervene. Most of the time, these powers remain dormant. Transactions flow normally. Accounts function without interruption. The system appears seamless. Yet the ability to disable access remains present within the architecture. It is not activated often, but it does not need to be. Its existence alone shapes the structure of modern finance. Once that structure becomes visible, the meaning of a bank balance begins to change. It is no longer simply money waiting to be used. It is participation in a system that decides when that use is allowed. The system usually says yes, but the authority to say no was built into it from the beginning. And the moment that authority becomes visible is often the moment people realize how the system actually works, not as a vault, not as a storage space for personal funds, but as a network. A network where the ability to use money depends on whether the system keeps it active or decides to disable it.